Welcome back, everyone. Today, we're diving into a topic that's both exciting and a little bit nerve-wracking: the Federal Reserve and its decision to end quantitative tightening, or QT, on December 1st. Now, you might be thinking, quantitative tightening? That sounds complicated. But don't worry, I'll break it down in simple terms, explain why it matters to investors like you, and why something as seemingly unrelated as Bitcoin is actually a big part of the story. So, let's start with what QT actually is. Quantitative tightening is essentially the opposite of quantitative easing. In simple terms, quantitative easing is when the Fed pumps money into the financial system to make borrowing cheaper, encourage spending, and generally stimulate the economy. QT, on the other hand, is when the Fed pulls money out of the system. They do this by letting bonds they own mature without reinvesting, or by selling bonds, which sucks cash out of the economy. It's basically the Fed's way of saying, we've done enough stimulus, now it's time to normalize things. On the surface, ending QT sounds like good news. After all, if the Fed stops tightening, that means borrowing costs aren't going to rise as quickly, and risk assets might get a little relief. But here's the catch: when the Fed ends QT, it often signals something else. It usually means that somewhere in the financial system, things are starting to feel fragile. There might be cracks we can't see, and the Fed is acting preemptively to avoid a bigger problem. Of course, they're not going to say, "Hey everyone, the system's fragile, panic a little." That would cause chaos. Instead, they frame it in safe, reassuring language. We're just staying ahead of the curve to prevent a recession. Investors, however, are skeptical. They've been around the block enough times to know that when the Fed makes these moves, it's often because they see trouble coming. So the collective investor mindset becomes, okay, we'll watch this closely, but I'm not going to rush into buying risky assets just yet. This hesitation is exactly what starts affecting the market. And this is where risk assets come into play. Risk assets are things like Nvidia stock, Tesla, or Bitcoin investments that can deliver high returns but also carry high risk. When investors sense uncertainty, they start selling or holding back, which causes these assets to drop in price. Now, Bitcoin is particularly interesting because it often acts as a canary in the coal mine. It's one of the first assets to react to macroeconomic shifts. Why? Because it's highly liquid and easy to sell, even on weekends when traditional markets are closed. This makes Bitcoin an early indicator of investor sentiment and risk perception. Looking at the technical charts, you might notice sudden drops or unusual volatility. What you're seeing isn't random. It's a reflection of investors reacting to anticipated changes in policy, fears of a fragile financial system, and general uncertainty about the future. Technical analysis charts, candlesticks, volume indicators. All of these are tools that capture investor psychology in real time. Now, let's take a step back and think about the broader implications. Ending QT is part of a larger macroeconomic story. Interest rates, inflation, bond yields, and central bank policies all interact in complex ways. When the Fed ends QT, it doesn't happen in isolation. It's linked to inflation trends, labor market conditions, corporate debt levels, and even geopolitical factors. Investors aren't just reacting to the Fed. They're reacting to a whole web of interrelated signals, trying to guess where the system is headed. And here's the tricky part. Because risk assets react first, they often overreact. Bitcoin, for example, might drop sharply while traditional stocks remain relatively stable for a few days. But this early movement can be misleading. Some investors panic and sell, which amplifies the drop, even if the underlying fundamentals haven't changed dramatically. This is a classic example of how market psychology drives price action faster than actual economic events. From a macro perspective, this behavior makes sense. Investors are essentially trying to price in all possible outcomes, best case, worst case, and everything in between. They're not just looking at current data, they're trying to predict the future. And because the future is inherently uncertain, they err on the side of caution. This caution shows up as volatility in risk assets, and early movers like Bitcoin tend to reflect this first. Over time, we see a ripple effect. The initial reaction in assets like Bitcoin can influence sentiment across the entire market. When Bitcoin drops, other cryptocurrencies often follow, along with tech stocks and high beta equities. This is why macro forces are so important. They don't just affect one market. They send waves through multiple asset classes. In conclusion, the Fed ending QT is a double-edged sword. On one hand, it might stabilize certain aspects of the market by stopping tightening. On the other hand, it signals potential fragility in the system, which makes investors nervous. The resulting behavior, selling risk assets, anticipating problems, watching Bitcoin as a barometer, shows how macro forces interact with technical markets. It's a fascinating dance between policy, psychology, and price action. And that's the macro force explanation in a nutshell.